Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. There have been some huge swings in the stock markets as the war in Iran has triggered fears about oil supplies. My panel discusses the impact of oil and its effect on stocks and the economy. And with fears of inflation and an apparent softening in the job market, the Fed is being pushed and pulled. So what should the Fed do? We'll have some opinions coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Kerry Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative management company, HF Management Company. Also sitting at the table is Kim Forrest of Boca Capital Partners, and the other spot at the table is occupied by Michael Godwin. Michael is the Chief Investment Officer for Fragasso Financial Advisors. I hope you all are doing well.
Yes.
Good.
Yes.
Great. Well, first, let's take a look at the market since we last met about 2 weeks ago. And if you look at the charts like I like to do, you can see something might be brewing. From the end of January through the end of February, the S&P 500 was trading within a 200-point range, edging toward the lower side. It felt like something had to give, and it did. The U.S. and Israel started bombing Iran, which spread fears about the oil supply, and the S&P 500 had a drop of 300 points in intraday trading in those 8 days that I'm taking a look at. Now, yesterday morning, it looked as if we were now staring into a bottomless pit. But just a word from the White House and a decision to release oil reserves, the S&P 500, which was down 174 points yesterday morning, bounced dramatically and ended the day up 56 points. That is a 230-point intraday swing. So now, how have you fared, I should ask, during this move of near depression and near euphoria? So, Kerry, I will begin with you. Did you have your clients sit tight, or did you recommend pulling back on some holdings? And how do you recommend we proceed during these volatile times? Because I have a feeling this thing is not over.
Well, I think the first thing to realize is that we've been here before, right? We've had several scenarios, that relate directly to what we're kind of dealing with, which is an oil shock. So this isn't our first rodeo. As it relates to clients, the answer is we have had our clients sit tight. Our investment process really keeps our clients aligned in terms of their risk tolerance and the expected outcomes. And the modeling we do accounts for things like this. We stress test portfolios, so we know, or at least have some idea, of how portfolios will react to different scenarios. And this scenario specifically with oil, when you distill it down to what it really means, has to do with inflation. And it has to do with the impact that higher energy prices may have on the economy, which is why we're seeing such volatility. One of the things, and we saw it yesterday, is that one sentence can change the direction of the market. And we also know that the biggest up days in the market are immediately following the biggest down days. You cannot be out of the market for that. So, this is all about portfolio construction, knowing your clients, and making sure that you have an understanding of what various shocks may be. Whether it was, we actually really look at the financial crisis, which was one of the deepest shocks that we had, to see and stress test portfolios. Very different to a degree than what we're dealing with now, but we can go back to the war in Iraq. We can go back to the 70s when we had the oil embargo. We can go back to the late 70s, early 80s when, we had an Iranian situation. So that history really helps us in terms of how we establish portfolios from the get-go.
Michael, I'm sure you told everyone to jump off the ledge, right?
I did, Stacy. Thanks for talking for me there. No, I'm borderline speechless here. I mean, Carrie and I are kind of on the same page regarding this. We did nothing in portfolios. I've mentioned this a million times before. I feel like, and at least with clients, is you can't invest based on geopolitical news because you have no idea what's going to happen. You're at that point you're trading. We're not trading. We're investing here at Free So, we have not done much in the ways of adjustments of portfolios. It's a decent time to take a look and see if you could do some loss harvesting, which we've done across the board over the past 2 weeks or so. But overall, the only thing I'm trying to do is get a direct line to the White House to see if I can get a little bit of information a little bit ahead of, what's gonna the markets there.
Have you been successful yet?
I have not yet, but I'm working on it.
Okay, that's good.
But then again, kind of like Pittsburgh weather with the White House, wait 15 minutes, you'll get another story.
Probably true. Probably true.
Well, I guess this leads me to two questions. And the first one is this. And so, is this a sign that you just pulled back, which you've already answered that question, but is it a time then to buy?
Let me jump in here. So I am an asset manager, not really a wealth manager. So I have new accounts opening all the time, and they're not invested equally, right? So you come in, you have either other holdings or cash, and it's exactly on these kind of crazy times that it is time to put money to work. And actually, it's time to put money to work in my existing clients and rebalance them, because we've had like some tremendous winners and some stocks that didn't keep up, but we have to rebalance. So in the last couple of weeks, we've been actively trading, which is ironic, because even though I'm an active manager, my opinion hasn't changed of the stocks that we hold. It's just that you've gotten an opportunity to either sell ones that have done very well and then buy ones that may do better in the future. We don't guarantee anything. That's the should, could, would. So that is what we've been doing. And it's times like these that really do give you opportunities to buy things that are completely hated for no good reason.
All right, that leads me to the second part of this question. And Carrie, you've kind of touched on this already, and that is the impact of oil on the markets themselves. And basically, you're saying it's all because of the fears of inflation more than anything else, not that a company uses oil or energy more than some other company?
Well, I mean, you have to factor that in. Energy across the board obviously is inflationary because we individually consume it and companies consume it. So, if you're transporting goods, you're going to feel the impact of it. Now, one thing that we need to recognize is that our economy is a lot broader than it used to be, shifting from a manufacturing economy to a service economy, now to an AI economy. Every company will be impacted differently, but at the end of the day, that does impact earnings. So we have to pay very close attention to how this may play out in terms of the broader economy. We know that the employment situation is softening. So we have to continue to watch that, because now if consumers have less money to spend at Target because they're spending it at the gas pump, that's really where and why the market moved. Because is this an extended period, or is it the news we got yesterday, where this is more of a temporary? So you have to definitely watch the news flow to better understand the overall impact on the economy.
The economy is incredibly oil-centric still. As Carrie mentioned, transportation. Most trucks are running on some sort of carbon-based fuel. Most cars continue to run on some form of carbon-based fuel. Although there's 5 or 10% are electric now, and I don't know, maybe 15 or 20%, including the hybrids versions, but I haven't seen that number. I'm guessing. Still 80 to 90% of the cars run on gasoline. And so you've got that dipping into people's budgets. And if the Strait of Hormuz stay, or however you say that, stays shut, it's going to be a big deal. Even though the lion's share of the energy going through that strait goes to Asia, it's kind of like a bathtub. If you dip a glass into one side of the glass bathtub and take the water out, the other side goes down too. So it's a world market, and the supply of energy is over the world, and it's not regional. It's so if there's a supply disruption to one region, it's going to impact everybody else.
And what's interesting, Frank, is that it is so interconnected. And one of the positives is that when we look at the energy consumption that is driven by AI, because AI takes a lot of energy, a large amount of that energy is renewable energy. So, again, when we're looking at stocks and different companies, you really have to look at, particularly with these AI companies, right? Like what kind of energy is being consumed.
For these data centers, yeah. Carrie, you touched on this, and I'll throw this one out. You touched on the fact that we saw some unemployment numbers which really didn't look that great, according to the government. I believe on Friday it released it, and what was it? A drop of 92,000 jobs or something like that they estimated. So I'll ask each one of you this: that if you're a member of the Fed, what do you do right now? You've got two being pushed one way and pulled the other in the fact that you could have inflationary concerns with oil, as you've mentioned, but also if the labor market is softening, you can't let that get out of hand. So if you're a member of the Fed, what do you do?
If I were a member of the Fed, I would do absolutely nothing. I would leave everything alone. I wouldn't shrink the balance sheet and take that money out of the economy. I wouldn't add to the balance sheet, although this war is probably going to force them to. By choice, I wouldn't do that. And I would leave interest rates right where they are. They're not oppressive at all. The things that need to get done will get done, and things that are profitable will get done. If there are no profitable ventures, any interest rate's expensive, and so I would do nothing. The economy is there's too much in flux, and too much can turn on a dime to be making long-term decisions with short-term events.
If I were a member of the Fed, I'd quit.
That's because the White House won't call you back.
Right. What you're seeing, though, play out, the market was predicting 2 rate cuts this year, by the end of this year. That's kind of come down a little bit because of the inflation dynamic that Carrie mentioned before. The market was expecting a cut by June. Now the first cut's expected by September. So it's getting pushed out a little bit more. I think the job numbers on Friday, I think, were a little bit concerning, and it'll be interesting to see how they play out, this month. But the inflation dynamic, I do think, is going to be more temporary than anything else. Again, this is why we don't trade on geopolitical news, because you're trading on beliefs. I believe something's going to happen. I think the Iranian war, with the conflict war, whatever you want to call it, is going to be more short-lived than certainly the Russia-Ukraine war, in which case the Strait of Hormuz opens back up. To Frank's point, oil starts flowing again. It takes a while to turn the spigots back on for these oil refineries, for sure. It's not like you can flip the switch and they go back on, but overall it should be a little bit more temporary than what could transpire from the job markets, which, that could be a trend that persists. So if I were in the Fed, I would be leaning more towards a cut, but I think Frank's probably right. You don't do anything now. You kind of let the data play out a little bit, and then when you need to cut, you go ahead and make that action. But we talked about this before. The Fed essentially has 2 mandates, right? One, price stability, which is inflation, and full employment. They care more about the full employment than they do about inflation, I think. So that's where I think their mind's going to go if the next job report doesn't look quite as if that's as concerning as this prior one was.
Just to corroborate that a little bit, there's a reason they care more about employment than inflation. Right now, our national debt exceeds our GDP. If we can keep a some sort of a rein on national debt, and we allow inflation to be a little higher, the GDP will grow faster than the debt maybe, and that problem will go away. And we could debase our currency by allowing inflation to exceed, grow the economy beyond the national debt and make that problem seem to go away.
So if I were a member of the Fed, I would cut rates. And I'll tell you why. We do have some precedent here. We can go back and look at the Gulf War. We can go back and look at 2007, 2008, when we saw oil spike to $147 a barrel. What we saw in both scenarios is that the Fed cut rates. I mean, I think that like general consensus is oil prices go up, we have inflation, the Fed raises rates. That's not been the precedent with the last few oil shocks. I believe that this economy, I think the jobs numbers last week were a big deal. I think that the news that we're getting from corporations is a big deal. Everything from AI, replacing jobs, to the troubles that are happening in private credit, which we've talked about previously. So, you know, I really believe in the scenarios in those two examples of the Gulf War and 2007, 2008, there were recessionary pressures. Alan Greenspan in 1990, I believe it was, reduced rates in order to fend off a recession. And before this spike in oil, before this conflict happened, we had concerns about a softening jobs market and, you know, valuations and everything else. And when you look at recessions, generally oil spikes and oil issues are a big catalyst. So I would lean definitely more towards a rate cut. And the other factor, and why I think that's more of a possibility in the coming months, is that the Fed chair is going to change in May. And that appointee is coming from an administration that wants to see lower rates. So I think you've got some kind of tailwinds pushing more on the side of a rate cut. And, you know, back, Stacey, to your original question, like, what do you do? Once the market starts to get any sense of feel that rates are going to be cut, it's going to go up. So, you know, you can't time these things.
No, you can't time it. Kim, I don't know if you know this or not, but the other three panelists have elected you chairman of the Fed right now. So what would you do?
Finally, my rightful place. Okay, so totally kidding, maybe. So I've got issues with the BLS. I think their methodology
Bureau of Labor
is
Statistics, right?
terrible. Yes, they're the people that furnish the estimate on jobs. And if you look at their last 6 years, they've been terrible. Like, they are so many standard deviations out of whack and have to, they bring it back into alignment with what they think is the real working cohort and how large that is in the US. And we have just seen these huge corrections. So I look at the data that they gave this time and I say, this is just validating my assertion that that the survey does not work anymore, and they must go and review and rethink this fundamentally and quickly. So what do you look at instead? I look at state unemployment numbers, because those are actual people that are getting laid off or let go from the workforce, and that has not been trending up terribly. So I can take some comfort in that. Although that's not telling me about new jobs, that's telling me about layoffs. So I am leaning towards heavily, this is boys versus girls here, a rate cut. And a couple of reasons. Yes, we are undergoing a traumatic time here with a war. We're going to add to the balance sheet for sure. We're going to add debt to that. That is not a good thing at this point. And I agree with Frank that having somewhat higher inflation over the medium term will allow that to true up. That the proportion of the debt that we have, with a devalued dollar. Now, as Fed chairman, I have to think about our reserve currency status. And I have to tell you, I'm not a hawk for war, but I think the quickness with how the US has been able to decimate a country that had both Chinese and Russian systems for defense should give our two largest longtime foes, China and Russia, pause about their adventures in, military activity. So that would be Taiwan and an expanding Russian presence in, fighting more fronts than the Ukraine. So I think our reserve currency status is more or less guaranteed for the foreseeable future. So I'd feel comfortable lowering that interest rate. There we go. There's the answer. And not only that, I think it's going to drive home purchasing. We saw that today. A little news that more homes have been purchased. These are already built homes. And I think building of more homes has to occur, but we have to have lower interest rates for that. And lower mortgage rates will drive home ownership upwards, which I think would be great for employment as well. So that's how we get from reserve currency to lower interest rate.
Well, it's funny you bring out high housing, because if you take a look at my sheet of what I'm going to talk about, that's the next topic, as a matter of fact. And so it should be noted that late last week, the mortgage rates for the first time since 2022, I believe, traded a little bit below 6%. As of yesterday, they were back at 6.14%. But it raises the question, basically, is are we just still stuck in a situation where the housing market is trailing the rest of the economy, or do you all believe that, Kim, that we might be seeing some light at the end of the tunnel as far as the housing market goes?
Well, I would say that there's anytime rates are coming down, that's a positive. And although they've spiked, if we do see a rate cut, hopefully that will continue to edge, even though it doesn't have a direct correlation. But the point that rates have been coming down, mortgage rates have been coming down, is more a reflection of an economy that's softening than anything else. I think that, it will definitely help stimulate the housing market, because people that have low mortgage rates don't want to move. However, we still have a very significant inventory issue when it comes to housing. We just don't have enough. So hopefully we get, sustained lower interest rates, lower inflation, which will help the builders. And, there's also a big push in this country for affordable housing. When you think about the builders, are these McMansion communities, or are they actually building homes for the middle class? So there definitely are some structural issues in the housing market that lower interest rates, lower inflation will help with.
The interesting thing is lowering interest rates by 25 basis points, even 50 basis points. As you mentioned, Stacey, mortgages have come down a little bit below 6. From that difference from like 6.5 to 6 doesn't make a huge difference in your monthly payment. The big problem has been the fact that the housing market has gone up about 25% or so since COVID. So great, I'm a new home buyer. The prices are up, a quarter, 25%, but my mortgage payment is going to go down by 25 basis points or 50. And that's more at the margin than anything else. I mean, Carrie's point is we've talked about this a bunch. It's the housing inventory, the housing stock has just been non-existent. And we get housing starts coming up in 2 days to see how that's kind of progressing here. But as soon as we can get more and more building in the suburbs, more or less, than the urban areas, I think that's going to be helpful with new home buyers and people switching houses and whatnot. And again, the job market, Carrie talks about this a lot as well. If the job market can pick up, which we're not really seeing at all, but somebody leaving a job, going to another city, that just really helps spur the activity in the economy, the job market.
There's not a lot
Or
of
the house.
shifting around these days. There's not a lot of shifting around to jobs these days to create that dynamic. One thing that AI may allow is for people to live further away from the center cities. Part of the problem with housing costs is land costs. When I built a house 100 years ago, I paid $5,000 for a half an acre. Today, that half an acre probably sell for $150,000. Well, you can't put a $60,000 house on a $150,000 lot. You've got to put $1 million house on a $150,000 lot. And this is part of the problem. And the property close to cities is outrageously expensive and for expanding the housing stock. Hopefully, AI and interconnectivity and infrastructure build-outs and all the things that people talk about but we don't seem to be progressing very well, will allow people to live 25 miles from the city where they can buy a lot for $10,000 and put up a 2,000-3,000 square foot home, which is something they can afford. I look at this as structural dynamics. I have no clue how to fix these problems, but to me, they're the problem, not interest rates.
Why don't we just go ahead and wrap it up here? We've been almost our regular time, so if we try to get into another topic, we'll go well over. I want to thank you guys once again for your insight on all of this, and congratulations on your appointment to the Fed board that I just made for each and every one of you. But we'll continue our look at investing in the economy in future editions. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. So thanks again for joining us. We'll see you again the next time for The Bull, the Bear, and You.